A very important relationship to understand is how changing relative factor prices affects marginal productivities. This occurs as firms react to the changing factor prices by changing their use of inputs into the production process. Generally, we talk about this in terms of capital and labor usage. So we will link relative price changes to relative factor price changes, and then changing capital labor usage and marginal productivity changes. So first we'll analyze the effects of changing the wage-rental ratio, and we'll assume that a good called X is capital intensive and good Y is labor intensive, using the standard definitions of those two terms. As a consequence of these wage-rental changes, there will be a change in the capital-labor ratio in each industry, and then we'll analyze the effects on the marginal productivities. So let's imagine that originally industry Y uses 200 units of capital and 200 units of labor. The X industry uses 40 of capital, 5 of labor, with the total amount of capital equal to 240 and the total amount of labor as 205. It's important to keep in mind that whatever changes are made in the use of capital and labor in the two industries, they still have to add up to this 240 units of capital and 205 units of labor, no matter how we rearrange. Now let's imagine that the relative price of X has risen, which will lead to a fall in the wage-rental ratio as resources move from the labor-intensive sector into the capital-intensive sector. So industry X will have a reason to expand, hire resources from the market, and industry Y has a motivation to reduce its output and let go resources into the factor markets. This consequently has an effect on the relative use of labor. Both industries, because labor has gotten cheaper in relative terms, will have an incentive to become relatively more labor intensive. At first blush, this seems confusing. How is it that both industries can use relatively more labor if there's a fixed amount of capital and labor in the economy? This is best understood by looking at a particular example. Recall the original situation with capital and labor usage spread between the two industries in the economy. Industry Y will contract, industry X expands, and let's say, for example, that the industry Y lets go of 5 units of capital, sending it to the X industry, and that 1 unit of labor goes from the Y industry into the X industry. Now the question is, what does that do to the capital labor usage in both industries? In particular, we now have the following allocation of capital and labor across the two industries. In the Y industry, it's 195 capital, 199 labor. And in the X industry, there are now 45 units of capital and 6 units of labor in industry X. So there's been a reallocation across the two industries in response to the price changes in the commodity markets and the price changes in the factor markets. And it is such that the capital labor ratio in the two industries has gone from 1 in the Y industry and 8 in the X industry to less than 1 and less than 8. Both industries have reduced their capital labor usage, and the total amount of capital and labor in the economy remains exactly as it was before. Notice as well that the total amount of capital and labor in the economy remains the same, even though they have been reallocated across the two sectors in response to the changes in the relative prices. We can depict this schematically in the following way. Again, the relative price of X rises, causes the wage-rental ratio to fall. This then gives a motivation for both industries, both the Y industry and the X industry, to lower their relative use of capital, i.e., increase their relative use of labor. That will then change the marginal productivity in the two industries. The marginal productivity of capital rises, and the marginal productivity of labor falls in both industries. It's important to note, in both industries, the same effect takes place. It is also very important to notice that this depiction only occurs when firms can choose both the amount of capital and the amount of labor. That is to say, this is not appropriate in the short run when either labor or capital would be fixed and immobile between industries.